Welcome to Wealth Hustle 247 podcast, your trusted guide to financial literacy, business innovation, and entrepreneurial success. Learn how to grow your wealth, make informed decisions, and turn your ideas into profitable ventures.
Want to know the secret sauce behind lasting wealth? In this episode, we're breaking down 6 assets that make you rich. Not just money, but the real game changers. Let's dive in.
Hey everyone, welcome back. Today, we're going to be taking a deep dive into 6 assets that, could really help you build some serious wealth. We're going to be looking at everything from real estate, the tangible stuff, to things that are a little more abstract, like intellectual property. And this is all based on the information that you sent to us. One of the interesting things about all these assets is that they're not about getting rich quick. It's more about understanding how they can appreciate in value and generate value over time.
Yeah, that's right. It's really like building a financial fortress, brick by brick, using all sorts of different tools and strategies to reach long-term financial security.
Okay, I love that analogy. I love thinking about it like that. So let's start with something that I think a lot of us are pretty familiar with, and that is real estate. We've all heard about its potential, but maybe for someone who's totally new to this, why is real estate such a powerful wealth building tool?
Well, one of the biggest reasons is scarcity. They're not making any more land, especially in those really desirable locations. So as cities grow and populations increase, the demand for housing and for commercial space goes up. But the supply of land, that's not going anywhere. That stays the same. So this just naturally drives prices up.
So it's like owning a piece of a pie that keeps growing. Like as the pie gets bigger, your slice becomes more valuable, even if you didn't do anything.
Exactly. And on top of that, you can use what's called leverage. You can use other people's money through mortgages to buy these properties. And this lets you control a much larger asset than you could with just your own savings.
Okay, now that's where it gets a little tricky for me. Can you break down this whole leverage thing a little bit more? Because it sounds really powerful, but I'm not sure I totally get it.
So imagine that you want to buy a property that's worth, let's say, $500,000, but you've only saved up $100,000. With a mortgage, the bank might lend you the other $400,000. So now you're in control of a $500,000 asset, but you've only really put in $100,000 of your own money. So if that property value increases by just 10%, your initial investment of $100,000, that's actually grown by 50%. That's the power of leverage.
Wow, that makes a lot of sense, but I've also heard, those horror stories, right, about people getting in over their heads with these mortgages. So it seems like leverage can also be kind of risky, right?
Oh, absolutely. Leverage, it's definitely a double-edged sword. So, those property values go down, your losses are going to be much bigger too. That's why it's so important to do your research, understand all the risks, and just be really comfortable with how much debt you're taking on.
So it's about finding that sweet spot between that potential reward and managing the risk. Now, let's say for those of us who maybe aren't ready to be landlords or deal with the hassle of property management, are there other ways to kind of tap into the power of real estate?
Absolutely. You can use what are called REITs, or real estate investment trusts. They're a fantastic alternative. They let you invest in a bunch of different properties without the headaches of actually owning them directly.
Okay, so I've heard of REITs, but I always thought those were for like really experienced investors. Is that true?
Not at all. Not at all. Just think of REITs like you're buying a tiny little piece of hundreds of different properties. So, office buildings, apartments, shopping malls, all being managed by professionals. And that way you get exposure to the market without having to worry about, fixing leaky faucets or dealing with tenants.
That definitely sounds less stressful than being a landlord. So REITs are like the hands-off approach to real estate investing.
Exactly. And here's something really interesting. REITs often have better returns than just owning a single property because they're spreading that risk across a bunch of different assets.
Okay, that's a great point. I'm gonna have to look into those REITs more myself. Now let's switch gears a little bit here and talk about the world of stocks and equities. Now, what makes owning a tiny piece of a company such a good way to build wealth?
Well, when you buy stock, you're basically buying a small ownership stake in that company. As the company grows and becomes more profitable, the value of your shares, that can go up too. It's kind of like planting a seed and then watching it grow into this big tree. over time, that initial investment you made, it can multiply in value.
So if I buy stock in a company that's, I don't know, maybe revolutionizing the tech industry or maybe developing life-saving medicines,
Yeah.
my investment could grow exponentially as those companies succeed.
Exactly. And this is where it gets really interesting. There's this concept called compounding, and it's almost like magic for investors.
Oh, I've heard of compounding, but I've never really understood how it works. Is it as amazing as everyone says it is?
So think about this. You invest, let's say, $1,000 in a stock, and that stock earns a 10% return in that first year. So now you have $1,100. But here's the catch. In that second year, you're earning 10% not on just your initial $1,000, but on the whole $1,100. And this just keeps happening. Year after year, your earnings are making more earnings, and that leads to exponential growth over time.
Wait, so it's like your money is making more money while you're sleeping?
You got it. That's the power of compounding. Of course, stock prices go up, they go down, and there's no guarantee that you're going to get consistent returns. But, over the long term, historically, the stock market has always trended upwards.
Okay, I'm starting to see how stocks can fit into a good wealth building strategy, but I've also heard about different investing styles, like value investing and growth investing. Do I need to understand all of that to get started?
It's definitely good to have a basic understanding, but you don't need to be a financial expert right away. Just think about it this way. Value investors, they're looking for those companies that are maybe undervalued, but that have really solid fundamentals, kind of like those bargain hunters. Growth investors, on the other hand, they focus on those companies that have really high growth potential, even if their current value is pretty high.
So it's like choosing between a reliable workhorse and a promising young racehorse.
You got it. And each one has its own risks and rewards, and the best approach really depends on your goals and your risk tolerance. But for now, just remember there are different ways to approach stock investing.
All right, well, that's definitely helpful. I'm feeling a little more confident about this whole stock thing now. Let's move on to something that I think might appeal to the risk takers out there, and that's owning a business. What are some of the wealth building advantages of kind of taking that entrepreneurial plunge?
Owning a business gives you the potential to really be in control of your own destiny. You can build something from the ground up and really enjoy the rewards of your hard work. It's all about solving problems, meeting those market needs, and giving your customers value.
Oh, I love that idea. Having complete control on that potential for unlimited growth. But building a business, that just sounds so daunting. Where does someone even begin with something like that?
It all really starts with an idea, a solution to a problem, a product or service that people need or want.
So it's about finding that sweet spot where your passion and your skills, they line up with an opportunity in the market.
Exactly. And then it's all about taking action, building a team, developing that product or service, and then getting it in front of customers.
Okay, I can see how that could be incredibly rewarding, but also incredibly challenging. What are some of the ways that businesses generate wealth?
Well, I think the most obvious is through profit, right? That's the money you make after you've paid all your expenses. But successful businesses, they also build these strong brands that become valuable assets on their own. Just think about companies like Apple or Nike. Their brand names alone are worth billions.
Oh, wow. So a strong brand is like having a golden goose that just lays golden eggs.
That's a great way to put it. A strong brand lets you charge more, attract those loyal customers, and even open doors to partnerships and collaborations.
Okay, I'm really starting to see how building a business can be such a powerful way to build wealth, even though it's definitely not for the faint of heart. Let's maybe move on to something a bit more stable, shall we?
Sounds good to me. What did you have in mind?
Let's talk about bonds. They may not be as exciting as stocks or as, alluring as entrepreneurship, but I've heard that they're a really important part of a well-rounded investment portfolio. Why is that?
Bonds are kind of like the steady, reliable workhorses of the investment world. They offer you this predictable income and are generally considered less risky than stocks.
So if stocks are like the roller coaster, bonds are more like the Ferris wheel, a slower, steadier ride.
That's a great analogy. When you buy a bond, you're essentially lending money to either a government or a corporation. In return, they agree to pay back that principal amount plus a fixed interest rate over a set period.
Oh, so it's like a guaranteed return on your investment. That sounds pretty appealing, especially in these times of market volatility.
Absolutely. And remember how we talked about diversification
Hmm.
earlier? Well, bonds are a great way to diversify that portfolio and reduce your overall risk.
So while stocks are, soaring one day and plummeting the next, bonds provide a sense of stability and predictability. Yeah.
Precisely. They can help to kind of cushion your portfolio during those market downturns, and they can also give you a steady stream of income, which is really important as you get closer to retirement.
Okay, I'm definitely seeing the value of bonds now, but I've also heard about different types of bonds, like government bonds and corporate bonds. Is there a simple way to kind of understand the differences between those?
Yeah, so think of government bonds as like the safest type of bond. They're backed by the full faith and credit of a government, so there's very little risk of default. Corporate bonds, though, those are issued by companies. So their risk level really depends on the financial strength of whoever's issuing it.
So a government bond is like lending money to your super reliable friend who always pays you back on time. And a corporate bond is maybe more like lending money to a friend who's full of great ideas, but maybe just a little less predictable.
Exactly. And just like with stocks, there's that trade-off between risk and that potential return. So government bonds offer lower returns because they're seen as safer. Corporate bonds have the potential for higher returns, but they come with more risk.
Okay, that makes sense. It seems like choosing the right mix of bonds really depends on your own risk tolerance and your financial goals. Now, let's move on to something maybe a little more abstract, shall we?
I'm intrigued. What's next on our deep dive?
Let's talk about intellectual property. It might not be as tangible as real estate or as familiar as stocks, but it's such a fascinating area with a lot of potential for wealth building.
Intellectual property is all about owning and protecting those creations, your ideas, your innovations. It's kind of like the invisible currency of this knowledge economy we're in.
So it's like owning the blueprint to a groundbreaking invention or the copyright to a best-selling song.
Exactly. Intellectual property includes patents, trademarks, copyrights, even trade secrets. It's basically this legal framework that gives you exclusive rights to your creative work.
Okay, I'm starting to get it. But why is intellectual property so valuable when we're talking about building wealth?
One major reason is its potential for passive income. So let's say you invent some revolutionary new technology and you get a patent on it. Now you can license that patent to other companies and let them use your invention in their products or services. And in exchange, you get royalty payments.
So it's like your invention is out there working for you, generating income while you sleep. That sounds pretty amazing.
That is the beauty of intellectual property. And it's not just patents. Think about a musician who writes a hit song. Every time that song is played on the radio, online, or used in a movie or TV show, they're getting royalties.
So a catchy jingle or a viral meme could actually generate passive income for whoever created it.
Exactly. And here's another interesting thing about intellectual property. A really strong brand name or logo that can become so valuable over time. Just look at companies like Coca-Cola or McDonald's. Those trademarks are worth billions because they represent, decades of building that brand, their marketing, their customer loyalty.
Wow, I never thought about it that way. So it's like a company's intellectual property it's invisible, but it's this incredibly powerful asset that adds to its overall value.
Precisely. And as our world becomes more and more driven by innovation and knowledge, intellectual property is only going to become even more important.
This has been really eye-opening. I'm starting to see intellectual property in a whole new light. Now, for our last asset, let's step into the world of tangible assets, precious metals, and commodities. What role can those play in building wealth?
Precious metals and commodities have always had this fascinating role in how wealth is created all throughout history. Take gold, for example. It's been a symbol of wealth and power for centuries. It's a finite resource, meaning there's only a limited amount of it, which contributes to its inherent value.
So when currencies are fluctuating or markets are volatile, people tend to turn to gold as kind of a safe haven.
Exactly. People often see gold as a hedge against inflation.
Yep.
And a good way to store value during times of economic uncertainty. And it's not just gold, silver, platinum, all of those other precious metals. They kind of have similar characteristics.
So precious metals are like a financial anchor that can help steady your portfolio when things get a little stormy.
That's a great way to put it. They provide diversification and can help to protect your wealth from inflation.
Okay, that makes sense. Now, what about commodities? I know they're, raw materials like oil and natural gas, agricultural products, but I'm not really sure how they fit into a wealth building strategy.
Well, commodities are really, really essential to global industries and economies.
Yeah.
Their prices are driven by supply and demand, which are influenced by all sorts of things like geopolitical events, weather patterns, and technological advancements.
So investing in commodities is like placing a bet on what's going to happen with global supply and demand in the future.
In a way, yes. And it can be a pretty wild ride because those commodity prices can fluctuate so much based on these global forces.
So it's not for the faint of heart.
It can definitely be a risky asset class, but it can also offer some big rewards for those who really understand the market and are willing to take on more risk.
This is fascinating. I'm starting to see how precious metals and commodities can add another layer of diversification to a well-rounded portfolio. And we've covered a lot of ground today. We explored 6 different assets with some really unique wealth building potential.
And honestly, we've only just scratched the surface here.
Yeah.
But I think it's really important to remember that building wealth is a really personal journey.
Absolutely. It's not about just blindly following someone else's strategy or chasing after the latest investment trend. It's about really understanding your own goals, your own risk tolerance, and finding the right mix of assets that work for you.
Well said. And that's exactly what we're going to be looking into more in the next part of our deep dive. We'll look at the key principles of creating a personalized wealth building strategy that fits your own needs and aspirations.
I'm looking forward to that. This has been such an eye-opening conversation, and I'm sure our listeners are really eager to learn more about how to put all these pieces together. So stay tuned for the next part of our deep dive into the world of wealth creation.
Welcome back to our deep dive into the 6 assets that can make you rich. In the last part, we went over some pretty fascinating insights about, real estate stocks, businesses, bonds, even intellectual property, and precious metals and commodities. So what stood out to you the most from all of that?
I think what really struck me is how each asset kind of has its own personality. You know what I mean? Like real estate, that's your steady, reliable friend. Stocks, well, those are exciting, but sometimes a little unpredictable. And businesses, they're like the ambitious go-getters. It's just fascinating to see how they can all work together to help you build wealth.
That's a great observation. And that's exactly why building a diversified portfolio is so important. It's like you're assembling a team of all-stars. Each one have their own strengths, their own weaknesses, and they're all there to help you achieve those financial goals.
Okay, I really like that analogy. So let's dive back into those individual asset personalities. We talked about leverage in real estate, but I'm kind of curious about some practical strategies. If someone is ready to, really jump into real estate investing, where do they even begin?
Well, the first thing you got to do is define your goals. What are you hoping to get out of this? Are you looking for, that steady rental income, or maybe long-term appreciation, or maybe even a combination of the two?
So it's not just about, finding a property that you like. It's about really making sure that investment aligns with your overall financial goals.
Exactly. Once you have a good idea of what you want to achieve, then you can start looking into specific markets and neighborhoods that really fit your criteria. And remember, location is absolutely key in real estate. It's not just about finding a trendy area. It's about understanding the local market, the zoning regulations, and the potential for growth in the future.
So it's like being a detective, piecing together clues to find those hidden gems with the best potential for investment.
That's a great way to think about it. And don't be afraid to reach out to people, those local real estate agents, property managers, even other investors, and get their take on things. Networking can be really, really valuable in this field.
Okay, so it's a combination of research, due diligence, and really tapping into the knowledge of experts. Now, let's say someone has found a property, it meets their criteria, it's within their budget. What are some of those key things they should consider before they make an offer?
Well, one crucial factor is the property's condition. Don't just rely on what the seller is telling you. Get a professional inspection done. That way you can uncover any potential problems that could end up costing you a lot of money down the road.
So it's like getting a checkup for the property to make sure it's financially healthy.
Exactly. Another important thing is the financing. Shop around for the best mortgage rates and terms, and make sure that you're completely comfortable with those monthly payments.
And speaking of financing, we were talking earlier about leverage and the power of it, but also, the risks that come with it. How can someone figure out the right amount of leverage for their situation?
That's a really good question, and it really depends on your risk tolerance and your overall financial situation. If you want to be more conservative, you might put down a larger down payment. That way, you reduce how much you have to borrow, and keep those monthly payments lower.
So a smaller mortgage means less risk, but it also means you're, tying up more of your own capital.
That's right. But if you want to be more aggressive, you might put down a smaller down payment and then leverage more. And that could really boost your returns, but of course it also increases that risk.
So it's kind of like choosing between, playing it safe and going for a home run, right?
Yep.
Each approach has its own potential rewards and risks.
Exactly. It's all about finding that balance that really works for you, your financial goals and what you're comfortable with. Now, for those who, they like real estate, but they prefer something a little more hands-off, we were talking about REITs in the last part, let's dive a little deeper into those.
Yeah, I'd love to hear more about that. I'm especially interested in how REITs can offer those diversification benefits. Can you talk a little bit more about that?
Of course. REITs typically invest in a whole range of property types. Office buildings, shopping malls, apartments, industrial warehouses, even healthcare facilities.
Right.
And they do this across all sorts of different geographic locations. So that diversification really helps to spread out the risk, and it could potentially improve your returns compared to just owning a single property.
So instead of putting all your eggs in one real estate basket, REITs let you spread them out across all sorts of different properties managed by professionals.
That's a great way to put it. And here's another interesting point. REITs are actually legally required to distribute at least 90% of their taxable income to their shareholders as dividends.
Oh, wow. So on top of that potential appreciation, investors are also getting a steady stream of passive income from those dividends. That sounds pretty appealing.
It definitely can be. And don't forget, REITs are publicly traded, so you can easily buy and sell those shares whenever you need to.
Oh, that's a big advantage over traditional real estate, which can be a lot harder to sell quickly and can really tie up your money for a long time. Okay, I'm really starting to see how REITs can be such a valuable tool for real estate investors of all levels. Now let's shift gears again and talk about the world of stocks and equities. We talked about compounding earlier and different investing styles. What are some practical tips for someone who's ready to, actually start investing in the stock market?
Well, I think one of the most important things is to start early. The sooner you start investing, the more time your money has to grow through the power of compounding.
So even if someone can only invest a small amount every month, it's still better to get started, sooner rather than later.
Absolutely. Time is your best friend when it comes to investing. Even those small, consistent contributions can really add up to something significant over time.
Okay, that's really encouraging. Now, let's say someone has decided to start investing. How do they actually choose which stocks to buy? It can feel really overwhelming with so many different companies out there.
It can be overwhelming, yeah. But, just remember, you don't need to become a financial expert overnight. Start by focusing on those companies that you really, really understand, companies whose products or services you actually use.
So if I'm a big fan of, I don't know, certain tech companies, gadgets, or maybe I really love a certain coffee chains, lattes. Those might be good places to start my research.
Exactly. It's a lot easier to really understand a company's business model and their potential for growth if you're already familiar with their products and services.
That makes a lot of sense. But besides just, liking their products, what are some other key factors to consider when you're evaluating a company's stock?
Well, you want to look for companies that have a good track record of profitability. You want to look for companies that have a competitive edge in their industry and a really solid management team. Read those financial statements, research their competitors, and try to get a sense of their long-term potential for growth.
So it's kind of a combination of those quantitative factors like their financial performance and those more qualitative factors like the strength of their leadership and their position in the market.
Exactly. And remember, diversification is still key. Don't put all your eggs in one basket, even if you think that this particular company is the next big thing. Spread your investments across different companies, different industries, and even different asset classes. That way you can reduce your overall risk.
So it's kind of like building a financial safety net by diversifying that portfolio.
That's a great analogy. Now, before we move on to the next asset class, I want to touch on something we mentioned briefly before. Those different investing styles. Remember, value investing is all about finding those undervalued companies with those solid fundamentals. Growth investing, though, that's all about finding those companies with that high growth potential.
Right. It's like choosing between that reliable workhorse and that promising young racehorse. But how do you know which style is right for you?
Well, that depends on your own personal goals, your risk tolerance, and your time horizon. Value investing tends to be a bit more conservative. You're focusing on companies that the market is currently undervaluing. Growth investing, on the other hand, that's more aggressive. You're looking for those companies with the potential for really rapid expansion.
So a value investor, they might be okay with slower, steadier growth, while a growth investor might be willing to handle a little bit more volatility if it means potentially getting those higher returns.
Exactly. And remember, there's no right or wrong answer here. The best approach is the one that really aligns with your individual situation and your investment philosophy.
Okay, well that's really helpful. Now let's move on to the world of entrepreneurship. We talked about the excitement and the challenges of owning a business last time, but for someone who's really intrigued by that idea, where do they even start?
It all starts with an idea for a solution to a problem or a product or service that fills a gap in the market, or maybe a way to do something better, faster, or cheaper than how it's being done right now.
So it's about finding that sweet spot where, your passion and your skills, they line up with a real need in the market.
Exactly. Once you've got that solid idea, you gotta validate it. Talk to some potential customers, do some market research, test those assumptions before you go investing a lot of time and resources.
So don't just, fall in love with your own idea. You got to get out there and see if the market is actually interested, right?
Exactly. And if that validation goes well, then you got to make a business plan. That's your roadmap to success. You outline your goals, your strategies, your financial projections, and basically how you plan to bring that idea to life.
Okay, so a business plan is kind of like the blueprint for building your entrepreneurial empire.
That's a great way to put it. It makes you think through every part of your business, from marketing and sales to operations and finance.
I can see how that would be so valuable, especially for someone who's never done this before. But writing a business plan, that sounds kind of daunting. Are there any resources out there to help with that?
Absolutely. There are tons of online resources, templates, even mentors and advisors who can help you put together a really solid business plan. And don't be afraid to reach out to other entrepreneurs in your field. They can offer some amazing insights and advice from their own experiences.
So it's a combination of doing your research, planning things out, and then really tapping into the wisdom of those who've already done it before.
Exactly.
Yeah.
Exactly. And remember, building a business, it's a marathon. It's not a sprint. You're going to face challenges, setbacks. You're going to have moments of doubt. But if you're persistent, If you're adaptable and you're willing to learn from those mistakes, you can overcome those obstacles and achieve your entrepreneurial dreams.
That's incredibly inspiring. Now let's move on to a more stable asset class, bonds. In the last part, we were talking about how bonds can offer that steady income stream, and
Yeah.
they act as the diversifier in a portfolio. But for someone who's never really dealt with bonds before, can you break down exactly how they work?
Sure. So imagine that you buy a bond that's issued by the U.S. government. It has a face value of, let's say, $1,000, and it's going to mature in 10 years. What you're basically doing is you're lending the government $1,000.
Yeah.
And they agree to pay you back that amount plus a fixed interest rate, let's say 3% over the next 10 years.
So I'd be getting $30 in interest every year for 10 years, and then at the end of that term, I get my $1,000 back.
Exactly. And those interest payments, those are usually made every 6 months. So you'd actually be getting $15 every 6 months.
Okay, that's pretty straightforward. But I've also heard people talk about bond yields. How do those fit into this?
Bond yields are just a way to measure the return you're getting on that bond investment. Think of it like it's the interest rate expressed as a percentage of the bond's current market price.
Okay, so if I buy a bond with a 3% coupon rate, but the price has gone up since it was first issued, the yield would actually be lower than 3%.
You got it. Bond prices and bond yields, they move in opposite directions. So when those prices go up, yields go down, and vice versa.
So it's like a seesaw. When one goes up, the other one goes down.
Exactly. And bond yields are affected by all sorts of things like interest rates, inflation expectations, and just the general economic outlook.
Okay, that makes sense. It seems like understanding those bond yields is really important for making good investment decisions. Now let's move on to the world of intellectual property. Last time we were talking about how it can generate passive income and it protects those creations of yours. But for someone who's totally new to all this, what are some practical things they can do to start building wealth through intellectual property?
Well, the first thing is to figure out, what intellectual property you have that's worth protecting. It could be a new invention, maybe a unique design, a catchy song, a really valuable software program, even a secret recipe.
So it's like taking inventory of your creative assets and figuring out which ones have the most potential to be commercially valuable.
Exactly. Once you've figured out what that valuable intellectual property is, the next step is to get the right legal protection for it. That could be a patent, a trademark, or a copyright, depending on what you've created.
Okay, so it's like putting a legal fence around your intellectual property to stop others from using it without your permission.
That's a great way to think about it. And once you have that legal protection, you can start thinking about ways to make money from it.
So that's where that passive income potential comes in.
Exactly. You can license your intellectual property to other companies, let them use it in their products or services, and you get those royalty payments. You can also just sell it outright or even start your own business around it.
It's amazing how intellectual property can generate wealth in so many different ways. But I imagine, navigating all the legal stuff with patents and trademarks and copyrights, that can get pretty complicated.
It can. That's why it's often a good idea to get some professional advice from an intellectual property lawyer. They can help you understand all the ins and outs of the law, file all the right paperwork, and just really protect those valuable creations of yours.
Yeah, that sounds like a wise investment. Now, for our final asset class, let's go back to the world of precious metals and commodities. We were talking before about how gold can be a good hedge against inflation and a safe store of value when the economy's uncertain. But for someone who's thinking about adding precious metals to their portfolio, what are some practical tips?
Well, one thing to think about is how you want to own those precious metals. You could buy physical gold like coins or bars, or you could invest in gold ETFs. Those are funds that track the price of gold.
So physical gold is like, holding a piece of history in your hand, and gold ETFs, they're a more convenient way to invest.
That's right. That's right. Physical gold, we got to store it somewhere and keep it safe, right? But gold ETFs, you can buy and sell those easily through a brokerage account.
Okay, that's helpful. Now, what about other precious metals like silver or platinum? Do they have similar benefits to gold?
Yeah, silver and platinum, they have some things in common with gold, like their value and their industrial uses. They can also be hedges against inflation and provide some diversification within a portfolio.
So it's like building a precious metals basket, with
Right.
all sorts of shiny assets.
That's a great way to think about it. And just like with any other investment, do your research, understand the risks, and make sure those precious metals fit into your overall financial goals.
All right, that's some solid advice. Now let's talk about commodities. We mentioned before how their prices go up and down based on global supply and demand. But for someone who's thinking about getting into the commodity markets, what are some of the key things to keep in mind?
Well, investing in commodities can be pretty volatile. The prices are influenced by a lot of different things, like geopolitical events, weather patterns, technological advancements, all sorts of stuff. You really got to understand the specific commodity you're investing in and what's driving those price changes.
So it's not just about, picking a random commodity and hoping for the best. It takes careful research and an analysis.
Exactly. And remember, just like with any other asset class, diversification is really important in commodity investing too. Don't put all your eggs in one basket. You want to spread those investments across different sectors like energy, agriculture, and metals.
So it's like creating this diversified commodity portfolio that can kind of ride out those stormy global market fluctuations.
That's a great way to put it. And remember, commodity investing is generally seen as more speculative, higher risk than investing in stocks or bonds.
Right.
So you got to be really clear about your risk tolerance and only invest what you can afford to lose.
All right, that's a crucial point. We've covered a lot in this part. We explored some practical strategies and things to consider for each of the six assets. I'm really starting to see how these can all fit together to build a well-rounded plan for building wealth.
And that's exactly what we're going to be talking about in more detail in the final part of our deep dive. We're going to bring it all together and talk about how to create a personalized strategy for building wealth, one that aligns with your own goals, your risk tolerance, and your time horizon.
I'm really looking forward to that. This has been such an insightful conversation. I'm sure our listeners are eager to learn how to put all of this together. So stay tuned for the grand finale of our deep dive into the world of wealth creation.
Welcome back to the final part of our deep dive into building wealth. We've explored some pretty amazing assets, haven't we? From real estate and stocks to that more unique world of intellectual property and even those tangible precious metals.
And throughout this whole journey, we've really emphasized that building wealth isn't about finding this one-size-fits-all formula. It's really personal, almost like crafting a bespoke suit.
Yeah. Okay. I love that analogy. It's like we're not just grabbing something off the rack. We're carefully tailoring our approach to really fit our own financial goals and our risk tolerance.
Exactly. So in this last part, let's talk about how you can create your own personalized strategy for building wealth, your own financial masterpiece.
Sounds good. Where do we even begin with this tailoring process? What are those key measurements we need to take?
Well, the first one, and probably the most important, is your financial goals. What are you ultimately saving for? Is it a down payment on your dream home, a comfortable retirement, or maybe you want to fund your child's education?
Yeah, those are some pretty big life goals, and I imagine the strategy for reaching them would look pretty different depending on.
Your goals, they're going to determine your investment timeline. That's another key measurement. Are you looking to achieve those goals in a few years, a decade from now, or even further down the road?
So if I want to retire early, let's say in 15 years, my strategy might need to involve taking on more risk to try to get those higher returns in that time frame.
Yeah, that's one approach. But let's say your goal is a down payment on a house in the next, I don't know, 5 years. You'd probably want to focus on a more conservative approach, just to protect that capital and minimize the risk of of any losses.
Yeah, it makes sense to match your investment strategy to the timeline of your goals. But how do we factor in risk tolerance? You know, that other crucial measurement. I feel like that's a very personal thing, and sometimes it's hard to really pinpoint.
You're absolutely right. Risk tolerance is basically how comfortable you are with the possibility of losing money if it means you might get higher returns. And it's often influenced by your personality, your life experiences, and your financial situation.
So someone who's, been through a big market crash, they might be more risk averse than someone who's just starting out with investing.
Yeah, that's a pretty common pattern. But remember, there's no right or wrong answer when it comes to risk tolerance. The most important thing is to just be honest with yourself about what you're comfortable with, and then choose those investments that align with that.
Okay, so we've got our financial goals, our timeline, and our risk tolerance. What's next in this financial tailoring process?
Now it's time to pick out the fabrics, so to speak. This is where we start thinking about the mix of assets. You know, your real estate, stocks, bonds, and all that'll make up your portfolio.
So this is where we decide which assets will help us reach those big life goals that we measured earlier.
Exactly, and this is where diversification really comes into play. It's that idea of not putting all your eggs in one basket. You want to spread out those investments across different asset classes that tend to react differently to what's going on in the market.
So if one part of my portfolio is down, another part might be up, and that helps to balance things out.
That's exactly right. Think about it this way. When the economy is growing, stocks usually do well, but bonds might lag behind a little bit. But then when the economy slows down, bonds tend to hold their value better than stocks. So by having both in your portfolio, you're in a better position to handle those ups and downs in the market.
Okay, I'm starting to see how diversification can really be like a shock absorber for your finances. But how do we actually decide, what percentage of our portfolio to put into each asset class?
Well, there are a lot of different approaches, but a good rule of thumb is to subtract your age from 100, and that percentage, that's what you'd allocate to stocks, and then the rest goes into bonds. So if you're 30, you might put 70% into stocks, and 30% into bonds.
So as you get older and closer to retirement, you gradually shift towards a more conservative mix with a higher percentage in bonds.
Exactly. Now, this is a simplified approach, and your ideal allocation is going to depend on your specific goals and risk tolerance. You can also factor in other assets like real estate, precious metals, even those alternative investments like private equity or venture capital.
Yeah, it's like adding more fabrics and textures to create this truly personalized and sophisticated financial garment.
I love that analogy. And remember, this isn't just a one-time decision. As your life changes, as your goals change, as the market changes, you need to review and rebalance your portfolio every so often.
So it's an ongoing process. It's not just a set it and forget it kind of thing. But how often should we be rebalancing?
A good rule of thumb is to review your portfolio at least once a year, or even more often if there are some big changes in your life or in the market. The goal is to make sure that your asset allocation is still lined up with your goals and your risk tolerance.
Okay, that makes sense. It's like getting a regular checkup for your finances, right? Just to make sure that everything is still running smoothly. But all this talk about asset allocation and rebalancing, it can feel a little technical. Are there any resources or tools out there that can help with this?
Absolutely. There are tons of resources online. There are financial calculators, even robo-advisors that can help you create and manage a diversified portfolio.
So for someone who might be feeling a little overwhelmed by all of this, there are options to get help and guidance along the way.
Absolutely. Absolutely. And don't underestimate the value of talking to a qualified financial advisor. They can give you that personalized guidance, help you develop a really comprehensive financial plan, and keep you accountable to your goals.
It's like having a personal financial tailor, right? They can guide you through the whole process from taking those measurements to picking out the fabrics and creating a perfectly fitted financial masterpiece.
That's a perfect way to put it. And remember, building wealth is a journey. It's not a destination. It's about making those smart choices, staying disciplined, and enjoying the process along the way.
This has been an incredible deep dive into the world of wealth creation. We learned so much about different assets, creating a personalized strategy, and how important diversification is, and patience, and seeking out guidance when we need it.
And the biggest takeaway here is this: building wealth is possible for anyone who's willing to put in the time and the effort. It's about making smart choices, staying focused on those goals, and never stopping learning and growing.
Thank you so much for joining us on this deep dive. We hope you feel empowered now to take control of your financial future and create a life of abundance and purpose.
That's it for today's episode of Wealth Hustle 247. Be sure to follow, like, comment, and share with others. Keep pushing toward your goals, and we'll see you in the next episode.